So concept of stock ownership goes back to Roman empires. Romans used to give out the contracts to private contractor, very similar to the modern day corporation today. And the structure of ownership of that private contracting company was very similar to the larger companies we have today. So most people understand the importance of stock market, how stock market works, and we also know that stock market has been the highest performing asset class compared to any other asset class. Probably the most misconception is to really understanding the real return of a stock market or what kind of return they can expect by investing into the stock market. So let's understand the historical stock market return. In the US, we have three main indices: Dow Jones, or also known as Dow, S&P 500, and NASDAQ, which is primarily technology stocks. So according to the measuringworth.com website, which is not-for-profit website and managed by some of the top universities in the US and UK, so if you look at the historical return or historical growth rate of Dow Jones from 1885, since inception, until the second quarter of 2019, then it is somewhere around 5.25% return basically. If you look at the S&P, which started in 1957, from 1957 until the second quarter of 2019, it is somewhere around 7%. And if you look at the return of the NASDAQ, which started in 1971 until the second quarter of the 2019, it is somewhere around 9 or 9.25. So let's go a little bit more in detail about this historical return. So if you look at from 1885 until 1950, stock market return was essentially miserable. So if you look at it, was somewhere around 3%. And at the same time, if you look at that one in the history, there are only 3 periods has been good for the stock market. So if you look at that one, which is 1950 to 1960, that's the time you will see the Dow Jones really gave the double-digit return. Then from 1980 to 2000, that was the golden period in the US history. So if you look at the return of the stock market, especially the Dow Jones, from 1980 to 2000, it is somewhere around 14%. And obviously from the 2010, we have seen now the very good return of the double-digit return basically. So 3 period one has to remember: 1950 to 1960, 1980 to 2000, and 2010 onward basically. But if you look at besides that, it was not so great return in the history. As we know, up to 1950, it was less than 3%. If you look at from 1960 to 1980, it is again less than 3% return. And the worst decade in the history of a stock market, that is the 2000 to 2010. Actually, S&P lost money in the entire decade. From the 2000 to 2010, the S&P essentially lost that money basically. So why there's a discrepancy between the Dow and NASDAQ? Obviously, NASDAQ is high risk technology stocks, but NASDAQ happened to be on the right side of the history, while the Dow happened to be mostly on the wrong side of the history. So what is the credible, reliable return one could look at? I guess that's the S&P that happened to be in the good and bad time. So the historical return of the S&P is that something that one could look at as the right return historically. So there are 3 factors affects your investment return. One is asset allocation. Number 2 is the expenses of investment, and third one is the taxation of your investment, and that I do talk much more in detail in my book. But the asset allocation, it's a type of various asset allocation. So there are mainly 3 asset classes, right? The stocks, bond, cash. Also, there are 3 other got very popular in the last few decades, which is the real estate, commodities, and life insurance. So these are the 6 main asset class. So the combination of the various asset class, that's called the asset allocation. So that is one factor which will affect your investment return over the longer term period. Second one is the expenses of investment. Now we know the historical real return of stock market. So if I'm expecting to make no more than 7% in a stock market, that's the time the expenses become very, very important. So whenever you invest into, say, mutual fund or some actively managed investment, then you are paying at least 1% in the expenses, if not more than 1.5%. The expenses become very important, and one needs to be very careful to minimize those expenses, because it's not the ability to perform or beat the market by that fund manager by a little bit margin, but it is the expenses will eat away your return. And the third thing is taxation of investment, because we know that 1/3 of your investment return will go into taxes. So if you don't manage your taxes, 1/3 will end up going into the taxes basically. And the 7% that we are talking, that is before the expenses and before the taxation. So once you factor in the expenses you pay on your investment and the taxes you pay, there's not a lot more room for you to make a decent return. So I talk in my book about how to really use various strategies in your investment. So, but few over here for the general information. So first, we want to make sure that we have a right expectation from the stock market investment, because most people really don't understand the real stock market return, and they have unusually high investment return expectation. So now you know that you cannot expect more than 7% over the longer term period. Obviously, if you invest for shorter term period, and if you happen to be right, you're going to make lots of money, and at the same time, if you be wrong, then you're going to lose lots of money. Also, we don't know what period we are going to fall on the historical return. So say, for example, if you have next 20 years to live or to invest, and you happen to be, say, from 1980 to 2000, then obviously you're going to be very happy because you made the most return out of the stock market. But if you happen to be from 1960 to 1980, then you are not going to be happy because you happen to be on the wrong side of the history. But it is a good expectation, somewhere in a range of 6 to 7% return from a stock market. So that is number one. Number two is to do the right asset allocation, and the Ray Dalio's asset allocation model really tells something, and that one can look at the Ray Dalio's all-weather portfolio asset allocation. I think that's going to give you some good starting point. Third thing is to minimize your expenses, because now we know that any actively managed mutual fund, or if you deal with stockbroker or the investment advisor, there will be fees, and that fees will not be less than 1%, even though it is disclosed or not disclosed. But somehow you're going to end up paying at least 1% fee. So you want to make sure that you minimize, and that one of the way to do that one is to invest into the index fund. Now the cost of your the index fund is somewhere around 10 cents compared to $1 or $1.50 you pay on actively managed fund. And the final one is essentially do the right tax planning. If you invest in that manner, and either you can minimize or don't pay any taxes on your investment, then you're really enhancing your investment return. And you can use some other money principles like money in motion, velocity of money principle. That's where you can really enhance your return, basically using some of the leveraging strategy. But these are some of the good tips or the strategy one can employ to really enhance their return or get the decent return from their investment.